Welcome back to Switzer and Australia's Business Channel. Bell Potter's strategist Charlie Aitken is always looking for wise investments, and given his recent writings, he's far more optimistic about stocks this year than last year. So let's see why and find out what themes he thinks are really going to work this year and what stocks he likes as a consequence. Charlie, thanks for coming in.
Always good to see you, Pete.
I've got to say I was really happy that your Qantas call ended up being fantastically positive for you.
That worked out well, but, you know, airlines are trading stocks, Pete, and I've got a little bit lucky there. I never predicted that the oil price would fall from 110
no, you didn't.
to 47 or whatever it fell to.
Yeah.
But the call that Qantas was bottoming and that Joyce was doing the right things and there was probably an operational profit uplift and a share price profit uplift coming was right. But I got a genuine bonus from the currency and the Australian and the oil
but
price.
you would have expected the currency.
The currency we have forecast. I still think the currency I've been bearish on for some time, and that's worked well. I continue to be bearish on the Aussie dollar.
Where do you think it's going to?
I think it'll bottom at my target's 68 cents, and I think it could be there by the end of the year. That's only against the US dollar. Against the yen and the euro and other currencies that are being devalued, it probably won't move much. But versus the US dollar, I think 68 cents could overshoot to 64 cents. Great thing for the economy, great thing for the market eventually.
Yeah, and so you're a little bit more confident about those dollar-sensitive stocks, and so George is still maintaining a very defensive strategy in his fund. But from your point of view, if you're trading and you're trying to position yourself where the market's going to go, I noticed, and correct me if I'm wrong, but I think the small ords have done pretty well this year, haven't they? After having a shocker.
Yeah, it was useless last year. But remember, there's a lot of mining stocks in it that dragged it down a bit last year as well.
But the dollar's helping the small ords.
Dollar's helping the small ords. Low cash rates are helping the small ords. Balance sheets are helping the small ords. Most balance sheets are in pretty good shape.
Yeah.
And I would say, relative to your other comments before, I think there's a bit more corporate confidence in small caps than there are in large cap boards. I think large cap boards tend to be quite conservative, just paying out higher dividends at the moment.
And they probably care more about Canberra than small businesses.
Correct. Small business is a little bit more entrepreneurial in the share market. And I think you've seen a little bit more educated growth risk taking there. Most of the M&A deals have been small caps this year. And I don't know, I just think there's a bit more confidence in the small cap market internally than there is in some of the large cap stocks.
Well, one big cap guy who is pretty positive is Jerry, and I always like it when Jerry's positive. It can be Jerry. He's never falsely positive. If it's crappy out there, he tells you.
No, but Jerry's well positioned. Jerry's got the double whammy of owning all the property on his balance sheet. Plus, he's got heavy leverage to the New South Wales renovation cycle. And if there's one thing that's certain is New South Wales, Queensland, Victoria are building more houses. And plus, the perception of higher property prices makes people want to redecorate their house.
Okay.
So Jerry's very, very well positioned, but he's got every theme, blowing in his tail.
Let's just then leverage off that, because historically economic recoveries start with housing recoveries. Are you thinking that in the second half of this year we'll start seeing some better data that will make Canberra look better in the eyes of business?
I think it gets worse at the data level before it gets better. You saw that in the GDP numbers from December. I think the GDP numbers from this quarter will be pretty sloppy. And I think that the unemployment will rise a little bit further. But the good news on the other side of that is we're going to get further rate cuts. The currency is going to come down further. And if you strip out, a bit like George said, the non-mining economy and non-mining services economy, I think it looks pretty good for the second half of the year and later on. So I think you've got to look at Australia as sort of mining, non-mining and everything else. And I think we just go back to a traditional housing and infrastructure and population growth led GDP growth period. Now, Canberra's an issue, but I think too many of us use Canberra as an excuse. At the end of the day...
Including CEOs.
I think CEOs are using it as too much of an excuse, actually. Now, but we can't have it both ways, because part of that CEO and board caution is giving us higher dividend payout ratios, higher dividends, and one of the reasons the market almost got to 6,000 the other day was actually board caution and higher dividend payout ratios in a period of ultra-low interest rates. So it's a little bit of a double-edged sword, that, but I think Canberra's used as too much of an excuse.
Okay.
It doesn't help, but it's too much of an excuse.
Rate cuts, April, are you expecting they'll cut again?
Yeah, I'd be 100% on that, down to 2%. I think cash rates in Australia could go lower and stay lower for longer than anyone expects. I mean, obviously, the government balance sheet's going to remain challenged for some period. Commodity prices are going to stay down for some period. Australian GDP growth will be below par for some extended period. I think the cash rate scenario, we're just recorrelating to the rest of the world. Think about it. Canada's an economy like us. Their cash rate's 0.75. UK, 0.5.
In a sense, of course, we played the old game. we became a bit like the whipping boy for the rest of the world, didn't we? Because people wanted to invest in our currency because interest rates were high. They kept the currency high and they hurt a lot of businesses.
Well, you think about the interest rate. Well, just think about it. Like the east coast of Australia, really, when the currency was 110, 106, was in recession, deep recession. Yeah. There was no tourists coming. Everything. We lost our entire manufacturing base because imports were cheaper. Now, as we come out the other side, tourists are coming back. Our manufacturing looks competitive. Building is happening. So.
This is the sort of stuff I'd love to hear coming out of Canberra more often.
Well, that we are
right. We are on the turning point.
I tell you what, when I looked this afternoon, the currency's 76 and the cash rate's coming down, and the settings are right. Don't worry about bulk commodities. Everyone knew they were going to come down, but the 80% of the economy that's not resources. Yeah. The settings are getting more constructive.
Gutsy calls. Is it time to buy resources on the basis that in a year or 2 years? No.
I just think it's done. They'll dwindle around. They will not recover until the commodity prices physically bottom.
Yeah.
You've seen that. They have little spikes around dividends and people collect their dividends and they just go back to sleep.
Yeah.
They're still in a downgrade cycle. The commodity prices haven't bottomed yet by the look of things. You get some offset for the currency. If I'm right on the currency, well, that's helpful to miners as long as commodity prices don't fall further. But it's simply the case is, if you believe in low interest rates for a long time in Australia, believe in a lower currency, you have to believe that commodity prices inversely don't really bounce.
Okay.
And so I'm happy to just let that be for the time.
When Europe, or if Europe, responds positively to QE, like America took 3 years.
It is.
Yeah. If it happens, will that then have a positive effect on commodity prices? So
I just don't.
Commodities will not be affected by improving Europe.
Think about it at the moment. We've got a strong US dollar. The US dollar is going to go higher. All commodities are denominated in US dollars. We've got the supply response in commodities has physically arrived in oil, coal, iron ore, gold, copper, the whole job lot. Outside of that, Chinese GDP growth is being revised down. The drivers of Chinese GDP growth are changing from steel intense to more sort of consumer spending and insurance, etc., etc. So, no, I don't. I think if you look at what QE did in America, then you work out it drove property prices higher, it drove unemployment down, it drove the share market up, it drove their currency down. What's happening in Europe? Now, QE started actually physically last night. Property market's up, share market's up, the DAX is up heavily. It's one of the best performing markets this year. Unemployment's probably stabilised, and really it's the same playbook from America 3 years ago. And Australia, not that we're doing QE, we've just joined the game of currency devaluation.
Yeah.
We've just joined that game, belatedly, but we've joined it. So what does that mean? Dividend yield compression, bond yield compression, lower interest rates, lower currency. It's the same playbook as America.
Some of my colleagues on this channel today advanced the point that the American bull markets never lasted longer than 7 years. My reaction was, sitting home watching it, well, this time it is different. Interest rates are really low and stuff like that. Because it's such a strange economic and market period and interest rate period, do you suspect this is going to be a longer bull market?
Yeah, and it's not a usual bull market, Pete. It hasn't been an earnings-driven bull market. It hasn't been an M&A-driven bull market.
Yep.
It's been really a buyback and yield compression, and there is no other alternative bull market. Eventually, the Fed forced everyone out of cash.
Yeah.
That's what happened.
Yeah.
Now, that's going to happen in Europe, and they got them. And then eventually, corporates got confident and started hiring people. You know what? QE and ZERP worked. They really did work. If you look at GDP growth and the targeting of what they're trying to do. Now there's no real inflation, but that's a little bit to do with commodity prices and the supply arriving as well. I think that, look, don't get me wrong, I think US equities underperform this year.
Yeah,
I think they'll underperform.
They've killed them, haven't they?
I think Europe will do better. I think Australian equities will do better than US equities, and we've already seen this year in a total return sense. They won't do better in US dollar terms because the US dollar will be strong.
Going up.
But if you look what Keir Nielsen from Platinum said the other day, who's arguably got the best performance record in Australian history in international investing, he's got 74% of his money in US dollars, but only 15% in US equities.
Yeah.
And that's right. He's more interested in Asia. He's more interested in Europe. Maybe even in Australia and New Zealand. So. Yeah. I think any pullbacks in America will be shallow. I think interest rates will be raised there very slowly, maybe even in 12 basis point moves. I mean, it could be quite small moves.
All right, Charlie, the stocks you like going forward?
I still believe that dividend yields in Australia, fully franked dividend yields, will be bid down as interest rates come down. That means that you'll get capital growth out of the banks, non-bank yield stocks, insurance. Telstra's still a favourite of mine.
You got Telstra going over 7?
I think Telstra will be a $7.50, $8 stock.
And you link it to Apple. You link it to Apple as well.
Well, Apple and Telstra are very well correlated, just in terms of Apple product sales and Telstra's mobile growth.
Yeah.
It's a pretty simple correlation. Works well. Telstra's lifting the dividend. I think Telstra's dividend yield will get bid down, and inversely, you'll get capital capital growth, and I think they're actually a cheap stock, and I think that the market will pay a high multiple for that. But we're in uncharted territory here. Everyone who says, oh, yields have never been lower or PEs have never been higher, well, cash rates have never been lower.
Precisely.
I mean, what are you comparing it to? What's your reference point?
Yeah. Well, when I learnt this game, I quickly learnt that if a PE is 20, I compare it to 5% interest rates,
Correct.
right? And so if interest rates are so low, I can go to 25, and that's a 4% interest rate, and so I can still keep playing at 25.
I'll tell you who's got this right, you know, and they might have got a little bit lucky with, like I did on Qantas with oil in terms of interest rates. The mums and dads of Australia and their self-managed super funds have got this right.
They watch this show. We've been pushing it here.
They read your reports. I know it's too easy. But they have bought stable and reliable dividend-paying stocks that have a little bit of dividend growth. They've been rewarded in a low interest rate environment, but they get the value of franking fully if they're over 60 in the pension phase of super. And quite frankly, those people should ignore every single commentator who talks about yield bubbles and bank shares being overvalued and Telstra being overvalued, because they're not relative to that age group and that in the pension phase of super in this interest rate and lower environment.
And Charlie, I always
mispriced.
No, I always throw in this that okay, we know stock markets go up and down, but at least if you buy good quality companies, when the market does crash, you can buy them at low prices. The dividends never fall at the same pace as share prices, and you can buy more of them and in a sense, dollar cost average down on those sort of companies.
Another point to remember, Pete, because only Australia and Europe's only just entered this ultra-low interest rate game. You know, in America, the pullbacks when they had ZIRP and QE were very shallow. The indices have basically done that for 6 years with little pullbacks. You know. That could be Australia now. Look at the pullback now. It's 100 points. It's nothing. Most of it's ex-dividends. That's just the ex-dividend.
The one interesting little point is that if we say we're in an unusual interest rate environment, it might mean that the US will only need a 1.5% increase in interest rates before the whole thing.
They may not even raise rates.
Well, that's right. That's the point. That's the point.
Because everyone else has put them down. 19 banks have put them. Central banks have put them down this year.
And
so
I think
relatively, that US dollar strength is hurting them a little bit now. You saw it in their reporting season. Starting to hurt them a little.
And I think Janet Yellen understands this even better than you and me.
Oh, a little bit, I expect.
Just a little bit better. All right. So, is there any other company that's an unusual one out there? It might be a smaller cap company that has good dividends that come on your radar.
Yesterday I wrote on Servcorp, a serviced office play. You know, about 800 million market cap, 80% of its earnings from overseas now. You know, a good play on boutiqueification, as I like to call it. You know, people who learn their business in a big firm and go and hang out
they started here, Servcorp, didn't they?
And Servcorp, to me, look, they just had a great result, paid an 11-cent dividend. Dividend was up on the year before quite substantially. A lot of growth ahead of them, guided to 15% EPS growth this year. I just think it's a good, solid Australian company that's taken a global footprint and had a go. They've actually grown their business.
I must get the CEO of Servcorp on the show.
No, it's a good business. So I'm looking for things like that because, I mean, we're well positioned in big cap, solid US dollar earning names, the Westfields, the CSLs, all that stuff. I'm looking for the next level of them, and things like Servcorp fit in very, very well. Charlie, great to see you, mate. Always, Peter. Thanks. Okay, that's Charlie Aitken. Of course, he writes on the Switzer Super Report, which we're very happy about. Coming up, we'll shine the spotlight on ANZ and its digital strategy with its head of digital strategy. That seems pretty wise.